All right, today we're going to unpack an investment thesis that makes a pretty bold claim that a small company called SUGS Lloyd could be a multi-bagger. We're going to break down the thinking behind this high conviction call piece by piece. So let's dive right in. First things first, what in the world is a multi-bagger? Well, the term actually comes from the legendary investor Peter Lynch. And it's simple, really. It's a stock that goes up so much that it returns many times what you first put in. A 5-bagger gives you a 5x return. A 10-bagger is 10x. You get the idea. It's the kind of home run investors dream of. And the analysis we're digging into today says SUGS Lloyd has exactly that kind of potential.
So how do you even spot one of these potential multi-baggers? What are the clues you should be looking for? Well, this particular analysis builds its case on a few key pillars. And the first one, it's all about the explosive growth story being told by the company's financials.
First up, we've got to look at the numbers. And according to this analysis, the financials are where this whole story really gets exciting. Let's start with a big one, 2.3x. The analysis shows the company's sales grew 2.3 times year over year. I mean, that's more than doubling your revenue in just 1 year. A huge signal of massive demand and that they're really getting things done. Okay, but is all that crazy growth actually making them any money? You bet. Net profit shot up 64% in that same period. So this isn't just growth for the sake of growth, it's profitable growth that's hitting the bottom line, where it counts. And check this out, it's not a flash in the pan. The analysis points to this consistent climb over 4 years. Operating profit went from just 3 crores, all the way up to 31 crores in the last 12 months. That tells you this is sustained performance, not just some lucky break. So with growth like that, you've got to ask, what's the stock actually worth? All right, so the growth story is explosive, we get it. But what about the price? Are you overpaying for all that excitement? Well, this brings us to the second pillar of the whole argument, valuation. And the idea here is that despite everything we just saw, this stock is, well, cheap. And to understand that, you just need to know about the PE ratio. Just think of it like a price tag. It basically tells you how many dollars you're paying for $1 of the company's earnings. And usually, a lower PE ratio can be a sign that a stock is a bargain compared to its peers. And this is where the story gets really interesting. The report shows SUGS Lloyd is trading at a PE of just 12.4. Now, look at its competitors. They're way up there, somewhere between 30 and 50. That's not just a small difference, it's a huge gap. And that gap is where the opportunity might be. And get this, the company's entire value, its market cap, is just 239 crores. Now, to the analyst, that's not a bad thing. It's actually a huge plus. Think about it. A small company has way more room to grow, to become 5 or even 10 times bigger than a giant corporation that's already at the top. Okay, so we've got strong growth, a cheap valuation, but you need one more thing, a rising tide to lift the boat, right? And that's pillar number 3, the massive industry tailwinds that SUGS Lloyd seems perfectly positioned to catch. So the company is playing in 3 really hot areas: solar, power infrastructure, and telecom. And the key takeaway here is that these aren't just random sectors. They're all getting a huge push from government initiatives and have super clear long-term demand. And let's just zoom in on solar for a second. The report is projecting that the entire Indian solar sector is going to grow at 20 to 25% every single year, all the way through 2030. That's not a wave, that's a tsunami of growth, and SUGS Lloyd is right there in the middle of it. And something just happened that's like pouring gasoline on the fire. The company's recent IPO. It didn't just bring in a bunch of fresh cash for them to expand, it also put them on the map, boosting their visibility and credibility in a big way. Okay, so far this sounds almost too good to be true, right? But we all know every investment has a flip side. It has risks. So let's see how the analysis tackles the potential pitfalls versus the company's strengths. To make a point about how safe this company might be, the analysis puts it side by side with a competitor, RMC Switchgears, which apparently has had some issues, like their CFO resigning. But when you look at SUGS Lloyd, the source says it has a much cleaner profile. No major red flags to speak of. And what about the smart money? Are the big players interested? Well, the thesis points out that, 2 institutional funds have already jumped in. You combine that with their really healthy profit margins, and it starts to look like a strong vote of confidence in the business. All right, let's pull all these threads together. We've got insane growth, a low price tag, a booming industry, and some smart money on board. So what's the final call? What does this all add up to? So how do you actually get from here to a 5 or 7x return? Well, the math, according to the source, is a pretty straightforward three-step process. First, sales have to keep growing, say 3 to 4 times over the next few years. As that happens, step 2, their earnings per share just skyrocket. And then, the final piece, the market wakes up, sees this, and re-rates that PE ratio up to match its peers. See, it's that 1-2 punch of both the business growing and the stock's valuation expanding that could unlock that multi-bagger potential. And all of that brings us to the final, crystal clear conclusion from the analyst. SUGS Lloyd Ltd equals high conviction multi-bagger pick. No mincing words there. So we'll leave you with this question because it really gets to the heart of the whole thing. We know there's competition out there. That's a given. So the real tension here is this. Is that incredible growth, combined with the tailwinds from the solar industry and what looks like a bargain valuation, is all of that enough to outweigh the risks? That's the question the market is ultimately going to have to answer.